Hello and welcome. In this lesson, we are going to uh, uh, delve into the idea of cost behavior in a little more depth and get introduced to this concept called contribution. Think of contribution as a measure of profit. As many of you who may be familiar with financial statements would know, uh, there is no single measure of profit. You take a typical income statement, it has measures such as gross profit, operating profit. Some companies report what is called as EBITDA, earning before interest, taxes, depreciation, and amortization. And then there is the net income or the net profit. So much in the same vein, contribution is a measurement of profit. But contribution is not reported to outsiders. It does not feature in the standard financial statements, like the income statement put out by a company. So if you're on the outside, you can estimate contribution, but managers on the inside can know the contribution of each product, each business unit. So how is this contribution measured? A sneak preview, the measurement of contribution is based on classifying costs into fixed and variable costs. So we are going to get some understanding of how contribution is measured and what exactly is a contribution statement, how to prepare one. And this will, of course, provide the link to the subsequent subsequent lesson that will talk about how to use contribution statement in managerial decision making. So in earlier lessons, I had told you that costs can be classified into fixed, variable, and semi-variable, and there are many management decisions that can be addressed using this classification of cost. One example is, will the prices of a product, let's say product X, be more competitive if the company increased the volume of production? A quick answer is to say yes. More you produce, less will be the cost per unit, the typical scale economy argument, and therefore more competitive the pricing can be. But we have to be careful. There has to be some kind of an analysis before you can conclude very firmly how the costs are going to behave with volume. And that's what this lesson is about. So a quick recap. So we know that there are three broad categories of costs, variable, semi-variable, and fixed. Examples, if you think about making tables, then the cost of wood could be a variable cost. It's also a direct cost, but the direct, indirect, remember, is a different classification based on traceability. And as I have said in earlier lessons, don't mix up the classification. In this lesson and in the couple of lessons that follow this lesson and are linked to this, we will use the classification based on behavior, or in other words, variable, semi-variable, and fixed. So the cost of electricity is an example of semi-variable cost, and factory rent is an example of fixed cost. So the main purpose of behavioral classification of cost is to understand how volume affects costs and then make decisions accordingly. So some of the typical questions that arise for managers to address using this classification: which costs will change with volume and how? Right? So more you produce, higher will be the cost, fair enough. But how will the change happen? For example, if you double the volume, will the cost double? They may not. And this is an empirical question, by which what I mean is you need to accumulate the data and check. And how these costs behave depend on the nature of the industry, the scale of operations, and so on, a myriad of factors. And so, beyond the basic observation that costs will increase with volume of production, we need to understand how this change will take place, and which costs will remain unchanged with volume. That's also an interesting question, because not all costs are going to change with volume. Take, for example, the factory rent. If you're paying rent for the factory per month and you're producing, let's say, 5,000 tables per month, as long as you don't want to expand the capacity, you don't need new space. So you can continue to produce 5,000 tables, but if you produce 4,000 tables, the rent would still be the same. So anything in the range of 0 to 5,000 tables, you can work with the same factory rent, or in other words, the same fixed cost, right? So we are going to make use of behavioral classification, of course, to answer questions like this. So let's start with some working definitions. Variable costs will vary with volume of output. Semi-variable costs will vary partly with volume of output. So they are between variable and fixed costs do not vary with volume of output within a certain range. So as I gave you an example, 0 tables to 5,000 tables, you don't need additional factory capacity, so you can work with the same level of factory rent. But maybe beyond 5,000 tables, you need to rent new space, and then a new amount of rent comes into the picture. As a result, the fixed cost could jump by a step. So do not assume that fixed costs will remain fixed. I'll talk more about this a bit later in the lesson. So fixed costs are fixed within a certain range. So there are 3 kinds of costs, and the output that we are talking about essentially links to your idea of the cost object. Right? So for a hotel, it could be number of room nights. For a restaurant, it could be number of hours, etc. So this is the final output of a business. Right? So a company that makes T-shirts, number of T-shirts. Or a company that makes milk, number of gallons of milk, and so on and so forth. And output can also be intermediate activities. So, for example, housekeeping is an activity to provide room service. So, housekeeping costs, how will they vary? Well, they may vary with room nights. If a room is occupied, you're going to do housekeeping. If the room is not occupied, you're not going to do housekeeping. But on the other hand, the housekeeping cost can also vary depending on what exactly is covered by the housekeeping, right? And how many times of housekeeping do you do in a day if a room is occupied? In some hotels, the housekeeping is once a day. In some hotels, they even do 3 times a day. Then in some cases with the housekeeping, they serve some things like fruits and chocolates and so on, and that can increase the cost of housekeeping. So therefore, housekeeping for a hotel is an intermediate activity. The ultimate output is provision of a room night to a customer. But these intermediate activities also merit this discussion about cost-volume relationship. So we are now talking about cost-volume, and then of course a third element in that relationship is the profit. So the concern for us is to understand the relation between costs and volume of activity or output, and then its ultimate impact of changes in volume on the bottom line, or in other words, profit. So this subject sometimes is referred to also as CVP, cost, volume, profit, easy for you to remember. And, I will refer to it from time to time as CVP, but moving on. So semi-variable costs are a little bit tricky for our analysis. So basically what we do is to break down the semi-variable costs into fixed and variable costs using some statistical techniques. These are not of importance for our current purposes, but let's say this is done. Then all semi-variable costs will partition into variable and fixed costs, and accordingly they will be assigned to the pool of variable costs or fixed costs. And then the analysis that we are going to discuss can go forward on the assumption that there are only 2 types of costs, namely variable and fixed. So this slide emphasizes a point that I made earlier. So fixed costs are fixed, but within a relevant range. So imagine a company, 10,000 square meters of space, $25,000 US of rent, producing 100,000 pair of shoes per month. So between 0 and 100,000 pairs of shoes, we can say that the rent is fixed at $25,000 a month. You want to increase the volume of production, do not expect the fixed cost to remain fixed. So no cost is fixed forever. You cannot infinitely increase production and expect any cost to remain fixed. So there are fixed costs, but they remain fixed within a range. So a related idea is this fixed cost per unit, And you have to be very careful how you use this number. And we will, of course, learn more about this through further discussions and case studies and so on. But basically, if your fixed cost, example, factory rent is $25,000 a month, and the volume of output is 10,000 units, then the fixed cost per unit becomes 2.5. But if the volume of output is 20,000 units, the fixed cost per unit comes down to 1.25. Note that the total amount of the fixed cost still remains the same at 25,000. That's not changing. And therefore, the fixed cost per unit might seem to reduce with the increase in volume. It might tempt you to believe that you are reducing the cost, but you're not reducing the cost. You're just increasing the volume of production and thereby reducing the cost per unit. Is that a good reason to increase the volume of your production? Probably not. So the point I wish to make is that increasing the volume of production should very much depend on whether there is a demand for the product, for that volume, right? Without addressing that question, increasing the volume just to reduce the cost per unit may not make sense. So the fixed cost has a slightly treacherous kind of behavior. It leads you to believe that you're reducing the cost by producing more. Don't get lured by that. But of course, scale economies do apply, and it might make sense to produce more as long as there is a market in which you can sell it. So we are now going to get introduced to this measure of profit called contribution, which is built on the idea of variable and fixed costs. So revenue per unit minus variable cost per unit. Now we are making it very operational, From a concept, we are now going into a measurement, and so we are now getting to the idea of what is a contribution per unit. So, as I explained at the beginning of the lesson, there are many different measurements of profit, and think of contribution as one of them. And as I said, this information about contribution is not publicly available. Of course, analysts can try and estimate it, but inside the company, product-wise, business unit-wise, you can get this measurement of contribution. So contribution can be measured per unit, and it can also be measured as a total contribution. Now I'm going to illustrate this with a simple example. So whenever you're discussing contribution, it is best to clarify whether the discussion is about contribution per unit, that means per table or per pair of shoe or per room night, or per gallon of milk, etc. Or are you talking about the total contribution at different volumes? Now let's look at this illustration, which will clarify what I'm trying to say. So we got this data on the left side of the screen on a per unit basis. The selling price is $10, the variable cost is $6, and therefore the contribution per unit is $4. But you see the total contribution is $400 at a volume of 100 units, but it is $2,000 at a volume of 500 units, right? So the contribution seems to be increasing linearly with volume. So when the volume doubles, the contribution doubles. From 100 to 200, the contribution doubles from 400 to 800. This is simply because the selling price per unit and the variable cost per unit are assumed to remain the same whether you produce and sell 100 units or you produce and sell 200 units. Now, this is a very important assumption. Now, some of you may, from practice, be able to argue that, look, if you want to sell 200 units, you may need to drop the price, and you may no longer be able to continue to sell at $10 per unit. Maybe the selling price is likely to go down, and that may well be the case. But the point that we are trying to make here is that under an assumption that the selling price per unit and the variable cost per unit does not change, increases or decreases in volume, in general, changes in volume are likely to see proportional changes in contribution. A doubling of volume sees a doubling of the contribution. Now, if you see this statement, the fixed costs do not feature here at all, right? So the fixed costs are kept out of the picture. And so we got the contribution per unit, which is selling price minus variable cost per unit, and then the total contribution, which is total sales minus total variable costs. And now suppose I bring in the fixed cost into the picture. Now you see in this slide, the top part is pretty much the same. The last two rows now show two additional items. One is the total fixed cost, which is 500, and you see this 500 doesn't change with volume. So it remains 500, whether the volume is 100 units, 200 units, or 500 units. And accordingly, the operating profit can be minus 100, a loss actually, at 100 units, and it is 1500 at 500 units. Now, the operating profit behaves a little bit differently from contribution. And therefore, what lies in between the contribution and the operating profit is this fixed cost. Right? So the fixed cost alters the relation between operating profit and volume. So volume doubles, contribution doubles. But if volume doubles, operating profit may more than double. Right? May more than double. And that is the effect of fixed cost, or what we call as the operating leverage. I'm introducing a new term here, please bear with me, but in general, more the fixed costs, higher is the operating leverage, and that leverage can work to your advantage if the volumes go up, and it can really sink you if volumes go down. So higher leverage is a risky thing, but not necessarily a bad thing. So how do you prepare a contribution statement? So you need a revenue per unit, variable cost per unit, and then you get the contribution per unit. Multiply that by the volume, and now you're planning. Remember that when we say there's 100 units, 200 units, 500 units, etc., this may be the plan, right? So you're asking the question, what will be the profit? What will be the contribution at these different volumes? When it comes to the actual statement, you don't have to do these various columns with different volumes of output. You just take one number, which is the actual volume, and then you get the actual contribution. Okay, so the contribution statement ends with the operating profits. Other items like that you typically find in an income statement, like interest expense, etc., or income taxes, they are ignored for the purpose of preparing the contribution statement. So, in summary, your typical financial accounting prepares an income statement, but in management accounting, you have a close cousin, which is called the contribution statement. And contribution is a measure that uses the behavioral classification of costs into fixed and variable costs. So selling price minus variable cost is the contribution. Now we will see how to use this in decision making in our next lesson. Thank you very much, and see you in our next lesson.